Hello and welcome back to another episode of the For the Property Investor podcast. And we're here with the weekly news. And of course, the man that brings us the news, Nick Bendel. Hello, Nick.
Hello, Owen. So great to be here for the weekly news.
Yes, it's and before we get into the news, has anything interesting work-wise happened for you in the past week?
Yeah, it's been a good week. My business, Hunter and Scribe, we're a copywriting agency that writes marketing content for finance and property professionals throughout Australia. We signed a new client last week. This was a buyer's agent who wants us to help him with an award submission. We've written 1 million award submissions over the years. I have been an awards judge, so this is something we're very, very good at. And that's why he decided to sign with us. And we've started working with him. And I hope we can help get him nominated as a finalist and even win.
Very good. And I'm sure you will do great things to help him hopefully do both.
I hope so too. And how's your week been?
My week's been pretty good. We have onboarded a new full-time staff member, new property manager, who's been great so far. And it's something that as a growing business, it's good to have good staff and to be able to help us service not just our current clients, but to help us continue to grow as well. So it's all things are looking good.
Fantastic. Are you ready for our first story today?
Yeah, hit me with it, Nick.
Budget may solve one housing problem but create another. Prominent finance journalist Alan Kohler has raised a confronting question for property investors. Will the federal budget's housing measures make residential real estate a poor investment for years, possibly decades to come? Kohler said he's optimistic for the first time that the tide has turned on housing affordability, but warned that improvement will come at a cost. He argued there's no way to make housing more affordable for non-owners while continuing to build the wealth of those who do own, and said the national consensus had now shifted firmly towards affordability. Kohler said property prices will probably remain roughly flat for a long time. For prospective buyers, that is welcome news. For those who have recently stretched themselves to buy, particularly those who use the government's 5% deposit scheme, the implications could be severe. They may never have positive equity in their house, Kohler wrote, describing the situation as a double disaster for those locked out of the market over the past 25 years and for many of those who found their way in. Owen, Alan Kohler said, given the recent change in policies, property prices will probably stay roughly where they are for a long time, maybe even 2 decades. Is he right?
Well, we won't know until we're 2 decades down the road. There's certainly been a shift in the market. We'll never know how long this shift lasts until it ends. One thing I do know is everyone that predicts the end of it will probably be wrong.
We need to record another episode in June 2046. How is your calendar placed?
Well, let's pencil it in, and we'll see if we can record it then.
Kohler's central argument is that you can't improve affordability for non-owners while continuing to build wealth for owners. It's one or the other. Do you think that's right?
To a point, yes. I mean, we still need to keep up with inflation, with the growth of property prices, and a little bit more would be nice as well. But at least inflation, at least the cost of construction we need to keep up with, because that's the big thing that is going to hurt the supply side of property. Is if property prices don't keep on increasing at the rate of the increasing cost of construction, then it won't be worthwhile for any builders or developers to actually build new houses.
Alan Kohler made another interesting point. He described the past 25 years as a double disaster. So he said it was bad for those locked out because they didn't get to build equity through property. And he says it's also been disastrous for many of those who got in because they've got very little equity. If prices go backwards, there'll be a negative equity. And if prices then don't grow for the next 10 or 20 years as he predicts, then maybe they'll never be in positive equity. This idea of the past 25 years as a double disaster, do you agree with that fairly bleak assessment?
Oh well, it's being a bit dramatic there. I think it's uh, and yes, certainly for people who got in earlier and took advantage of it, they've done well. And yeah, people who have got in late for the first time are probably looking, oh, what have I done? It's yes, the government has tricked us again in by telling us something was good where really it might have been something that was bad for us. So again, another reason for the government to stay out of the financial markets altogether and just let markets do their thing. So yes, little bit bleak in his assessment there. Yes, I think only time will tell how bleak it really is going to be.
For our second story, we're going to look at this from a different angle. Property market cycle enters new phase. Australia's national median property price was flat in May, according to data from Cotality, as cooling conditions spread across an increasing number of capital city markets. Cotality Research Director Tim Lawless said that while the speed of value change still varies significantly between cities, the direction is becoming more consistent, with most markets losing momentum as demand-side pressures intensify. Lawless noted the slowdown had been building well before the recent confluence of interest rate uncertainty, escalating geopolitical tension, and the federal budget's taxation changes, with most cities recording a peak in value growth during spring last year as affordability and serviceability constraints began to weigh more heavily on demand. More affordable price tiers continue to outperform higher-end segments across most capitals, although Lawless said even those markets are beginning to lose pace. The data points to a market in which the tailwinds that drove price growth through the post-pandemic period have largely dissipated, and in which buyers across most segments face an increasingly complex set of constraints. Owen, how much of the recent slowdown can be attributed to economic uncertainty versus simple affordability limits?
Um, well, I think it's too difficult to try and put a percentage, 60-40 or 50-50 at all, because it really comes down to each individual and their circumstances of how they've been affected. But yes, we did see the slowdown start to happen at the end of last year, and then with successive rate rises and changes to APRA policy as well for lending, really had a big hit on the market. But it really takes a few months for those things to show through. And then things like the federal budget coming in and just kicking people while they're down to really knock the wind and the confidence out of the market, which now leaves us in this position. And it's interesting to see that some people are cheering about this. It's like, yay, property prices are flattening or coming down. And it's just like, yeah, I can see why some people might be cheering, because it might give them the opportunity to get in themselves. And again, if that's what the market is now, then yes, it could give them that opportunity. But be careful what you ask for. It might give you the opportunity to get in and buy now. But if the market keeps on dropping further and further as a result of the lack of confidence in the market and general economic conditions, then you can be in a position where you're not cheering anymore.
Okay, well, let me follow up on that. If prices are stabilizing, maybe going down a bit, but not falling significantly, which is at least what's happening right now. What does that mean for buyers who have been waiting on the sidelines?
Yeah, well, as I was just saying, it's that's something where if it gives them the opportunity to get in now, and they're buying for the long term, then that's great. Great for them. They should take advantage of that opportunity. But I feel sad for the people that had to go into a scheme, which in a rising market where they were able to get in with only a 5% deposit, which means they've had to borrow 95%. And they're now looking at the potential for negative equity, where they could have waited and potentially had a 10% deposit as a result, and being able to get into the market without using some kind of government scheme with its restrictions as such. So I think the lesson to be learnt is the market is the market is the market, and you need to pay attention to the market and learn from it, and it will teach everyone a lesson eventually who tries to fiddle with it.
Prices are currently falling in Sydney, Melbourne and Canberra. They're still rising in the other capital cities, although, as we've discussed, the pace of growth is slowing. Which capital cities do you think are most vulnerable to further slowing conditions over the next 12 months?
I think the Melbourne market is very fragile with the economic conditions in Victoria and Melbourne. It's the way the state government there has treated the property investment market and the housing market. It's so fragile. Brisbane is quite robust, but it's had very good growth for very long term. Sydney, even though it's at the higher levels and the top end of the Sydney market, always falls hard whenever there is a turn. And yes, the broader market in Sydney could quite well come back a bit, but there's still a lot of demand, and it would likely be short-lived.
We're speaking of the future. Just before we move on to the next story, let me share some data with you from the past 10 years. This is from Catality. If you had to guess, what would you say the number one city in terms of growth has been over the past 10 years?
I'd say probably Brisbane.
You're correct, 120%. What do you reckon number two has been?
I'll be either Adelaide or Perth.
Oh, you're good. Number two is Adelaide at 112%. Number three is Perth at 110%. And then we have Hobart at 96%. And behind them, we have Canberra at 64, Sydney at 58, Melbourne at 35, and Darwin at 32.
Okay. There you go.
There you go. And it'll be interesting to see what the next 10 years looks like. How is your schedule placed for June 2036?
We're probably putting to paper there. It's a bit more predictable than 20 years out.
Okay, well, let's lock that in for a podcast episode. In the meantime, we'll move on to our final story for today. Listings surge as distressed sales rise in 3 states. The number of homes listed for sale nationally rose 10.4% in May compared with the previous month, and was 0.8% higher than the same time last year, according to SQM research, while new listings jumped 5% month on month and 12% year on year. SQM Managing Director Louis Christopher said the data points to a market losing momentum, describing May's listing surge as the strongest monthly rise in some time, and noting it marked the first time total supply had returned to positive annual territory in over a year. Christopher flagged a rise in distressed listings as a particular concern, though, distressed properties increased 5.1% over the month, with WA, South Australia and Queensland each recording rises of around 9%. In the ACT, distressed listings are now 38% above where they were a year ago. When supply returns this quickly while prices stall, it is usually an early sign that the market is at a turning point, Christopher said. He warned that Sydney and Melbourne remain most exposed to downside risk and said the next few months would confirm whether May did indeed mark the inflection point. So, Owen, we all know that listings data bounces around from month to month. So the question is, does the rise that we've seen in May reflect this natural volatility, or does it actually reflect a new trend?
No, I mean, I've lived and operated in this industry for this is probably the third time at least that I've seen this happen. It's just a natural course of events. There are things that have been done to make this worse, but at some point governments usually get their sticky fingers into things when that make these changes in markets worse, because they're appealing to people who are crying out because they're hurting. Usually in the coming months or year or two before we hit these peaks and changes. So it's it's just a natural course of things. Hopefully we're able to see people that are able to get out of any holes that they've dug for themselves, and in a fairly healthy way. Yes, but when we go through these changes in the market, unfortunately, there's some people that get caught in those changes.
Another thing noted by SQM was that distressed listings increased by 5.1% in May. Again, would that be monthly volatility, or do you think that would reflect a new trend?
It's probably a knee-jerk reaction to people suddenly coming on the market, thinking that their property is still going up in price, and they're suddenly starting to see that it might not be going up in price. So yes, let's get it on the market now. And there's people that might have bought recently that are suddenly maybe lost their job or had a life-changing situation where they need to sell. They might not have been in a position where the property value has gone up, and it might have actually gone backwards. So yes, at these times, when the tide changes and changes quite dramatically, unfortunately, some people get caught up in that and they get swept out.
Just following up from that, when listings rise, as we've seen happen over the past few weeks, buyers have more options and more negotiating power. So I'm wondering, Owen, what you should do if you're a vendor. Should you accept whatever you can get now because otherwise you might be forced to accept an even lower offer later? Or should you hold your ground in the hope the market returns to growth mode soon?
It depends on your situation. If you're looking at selling and buying in the same market, and especially if you're looking at selling and buying something, fairly, within a 20% difference in sort of price range, then as long as you're doing that in the same market, buying and selling in the same market, then you're in a position where you can take a lower price on your sale, because you would probably expect to be able to pick that up on your way through, especially if you're going up in value. You'll make that up and maybe more some if you're buying well. So that's probably the best thing to do. Now, unfortunately, if you're selling because you need to out of distress, then that can be a problem. You don't want to be chasing the ball down the hill. It's you want to cut it off as quickly as possible because yeah. So, but that's something that you need to make that decision based on your own financial circumstances. But at this stage, a bird in the hand is worthwhile looking at.
And just before we sign off, we've got an RBA cash rate announcement coming up next week. If you had to bet right now, what would you predict?
Ooh, yeah, we're seeing flattening of the property market. We saw GDP figures sort of flatten off as well, and come back a bit. We're seeing that Middle East Iran war, sort of not sure where it's going at the moment. So I think we're going to see a hold.
Okay, I'm going to predict another rate rise. That would make it 4 in a row. But I'm a bit of a hawk on these things. So
you are.
I believe in just shoving medicine down people's throats, whether they want it or not.
Yeah, well, they've I mean, everyone's taken their medicine and they've really taken it more as a suppository instead of orally, but in the last few months.
We're not shoving it down, we're shoving it up. That's what you're saying.
Well, yeah, that's really how people feel at the moment. It's really been given to them. Which is why the confidence in the market that wind has really been knocked out of the market in the last month or two. With everything that's happened this year so far, it's people are just deflated. And that federal budget was really the icing on the cake. If you want to kill an economy in terms of from a confidence level, deliver a budget like what the federal government just did. It's nuts. I can't remember a federal budget ever being discussed for this length of time like it has been. Like it's still on the morning morning television shows. They're still asking the politicians about the federal budget and the effects it's having on the electorate and the economy. So it's we've got a long way till the next election, but it seems like this one isn't going away.
Well, if nothing else, we live in interesting times, which means we have a lot to discuss each week. I look forward to chatting again next week.
Fantastic. Thank you again, Nick. And yes, we'll see you next week with the weekly news.